let's waste no time. Let's dive right into how to trade in a recession. This video will be broken into 5 different parts. If at any time I provide some value, show some love by following this channel. Part 1, the purpose. Every trader and investor is different. They have different timelines, different risk tolerances, and different financial goals. Your goals will dictate how you trade in a recession. My personal goals are to hedge against my long-term positions, make some money off of the increased volatility you see in bear markets, and preserve some capital so I can deploy that capital closer to a stock market bottom. That's why I personally trade in a bear market. And those are the goals that I look to achieve. Part 2, the trend. When things are good, when we're in a bull market, the trend is up and to the right. It's a buy the dip kind of market. On the contrary, when things are not so good, when we are in a bear market, the trend is down and to the right. And dips just keep on dipping. Buying in a bear market may feel like trying to catch a falling knife. And this is because you kinda are. There are 2 easy ways to determine the overall trend of the market. First, take a look at the 200-day moving average for a major index. It could be the S&P 500. Is that moving average downward sloping? Is it acting as a resistance, meaning that every time the index gets to that point, it shortly thereafter falls down? If so, then we are in an overall downtrend. If the inverse is happening and you see an upward sloping moving average acting as support, meaning that every time the index gets to that moving average, it bounces back up, then we are in an overall uptrend. The second way is you can look at the daily RSI. Draw a horizontal line at 50. Is the majority of the RSI below 50? If so, then it's likely you're in an overall downtrend. If the majority of the RSI is above 50, then it's likely you're in a overall uptrend. Part 3, the markets are forward looking. I want this to be very clear. At some point during a recession, the stock market will bottom. The trend ultimately almost always reverses back to the upside. And ultimately, in a recession, there is a generational opportunity to buy stocks for the long term. This is because markets are forward looking and will begin to price the end of a recession while we're still in one. So even though things seem really bad at that point, and it might feel like stocks are never going to rebound, the market will start to price in the end of that economic downturn and will form a bottom. At the time of this filming, based on the economic data we have obtained, the US right now is not in a recession just yet. However, it is very probable we are going to get into one. Based on that theory, it is also very unlikely that we've seen the bottom of the stock market. And the downtrend remains intact for now. Part 4, ways to make money. There are a few ways to make money trading in a recession and a bear market. The first way is to short shares. This is high risk with not the best reward. Unlike buying stocks where your risk is limited because a stock can only go to 0, the risk when shorting stocks is unlimited. And that's why shorting stocks can result in a loss that is more than 100%. But on the flip side, your max gain is capped at 100%. And for that reason alone, I prefer not to short shares. The second way is through what are called inverse ETFs. There are securities out there that will move inverse of other ETFs and stocks. For example, the SQQQ will move inverse of the QQQ. So when the Qs drop, the SQQ will rise. However, these inverse ETFs, because they are rebalanced daily, most of them, are not exactly built to buy for the long term. And these should only be used for short-term trades. The third way to trade in a bear market and a recession are through income-driven strategies, such as cash secured puts and covered calls. But these come with additional risk. During a bear market, implied volatility is going to be higher than usual. So you'll get compensated for this additional risk. But the odds, the probability of you having a cash secured put or a covered call that is assigned in a bear market is much higher. Therefore, you have to consider that. And selling cash secured puts can be dangerous because you're going to have to buy 100 shares at the strike price, which might be a big chunk of the cash you have on the sideline, for the stock just to continue to fall below technical support because the downside momentum is just too strong. The fourth way that you can trade in a bear market, which is my favorite way, are through put options. This is like shorting a stock, but the risk is limited and the reward is much higher. Put options make money when a stock goes down, and they have a defined risk. You can only lose what you put in, and they have a much higher reward. For instance, these put options we bought on CVNA are now up 750% in just 3 trading days. We turned $800 into $6,200. It was an insane trade, and this shows the power of put options, in particular put debit spreads. Buying put options or put debit spreads will also allow you to hedge against your long-term positions and help soften the blow when those stocks are falling. They can also help you accumulate capital in which you can save up and later put into the market when you're closer to a bottom. Now, like I said, I personally choose to trade debit spreads. They decrease your cost of entry to get into those put options and therefore increase your potential reward. When trading debit spreads, I personally look for risk to reward ratios that are 10-to-1 or higher. And here are a few trade examples of me doing just that. If you want live trade alerts, join the private Discord. A link is in the bio. Part 5, the summary. For me personally, the most important thing when trading in a recession or bear market is to hedge against my long-term positions and preserve capital. I'm looking to enter into put debit spreads with a risk to reward ratio of 10-to-1 or higher to hedge against my long-term positions, to make some money trading the decline in the overall stock market, and to preserve capital. Now that concludes this video. Any questions? Comment down below. Join the trading community, hit that follow, and I'll see you on the next one.